Nitin Rakesh joins in to talk about what has been a more quiet performance for the market this week. Nitin, morning. Is that what it's looking like, that the market has finally hit its period of range-bound trading?
Morning, Natali. I think we've had a fairly volatile period, in fact, over the last few weeks, thanks partly to domestic macro headwinds, interest rate, inflation, and the likes, and partly due to the macro issues coming out of the world, not just Middle East and oil, but also Japan and the earthquake. So I think clearly, in this kind of an environment, at best the market can stay sideways. Actually, there's a lot of people surprised that the market's actually not fallen much more than it should have. So clearly, I think it looks like that the market's trying to continue to digest all the news flow that's coming out from various fronts. And while we digest this news flow, it seems like that the best case scenario seems to really be continue to move in a zone.
Nitin, morning. So, do you think there would be a protracted period of this range-bound movement for the market, where we would be tottering between this 54 to 5600 zone, or do you think the zone, the support for the zone could move lower?
Well, I think clearly markets look at a few things, earnings being most important, followed by interest rates and valuations. And I think in this case, I don't think we're out of the woods yet when it comes to the fact that interest rates continue to seem to harden. Valuations, while they've become a little attractive in pockets, and it's not like they're a screaming buy that we are heading close to low teens or single digits. So I think at best, as I said, I think market needs to go through a time correction, even if price correction doesn't happen. And it will be a little more frustrating over the next few weeks and months, and market will look for the next set of cues. Obviously, the immediate ones being quarterly numbers, followed by what happens to the monsoon, and eventually, at what point do we think that inflation starts to show some signs of cooling off, which really hasn't happened so far.
Nitin, what did you take away from the credit policy? The market seemed to come away quite nervous. A lot of the performance we saw in rate sensitives like the banks began to snap.
I think clearly this wasn't a surprise that we saw another 25 basis points hike, even though about a few weeks ago it seemed like we were getting towards the end of the interest rate hikes. But I think the stubborn nature of inflation has kind of forced the RBI to do something again. And I don't think this is the last of the interest rate hikes yet either. I think that's really what the market is getting nervous about. Specifically, things like banks, focus is primarily on whether the banks have the ability and the market has the capacity to actually absorb the pass-through of the hikes on interest rates. So I think it looks like that deposit rates have also started to peak. But they're not passing the interest rate hikes anymore to the lenders. So clearly, I think to the borrowers. So I think clearly it looks like that for the short term, there's going to be pressure on the margins on anything that was focusing on the interest rate cycle. And similarly, I think it'll start having an impact on the consumption as well, especially on things that are discretionary in nature. So I think that's really what's causing a lot of concern. And as I said earlier, it really has to happen that we have to see the flattening of the interest rates or the peaking of the curve before we start seeing equity markets to react positively.
Can this range-bound trading make the market drift closer to its most recent low, Nitin, or is there some amount of confidence about the fact that perhaps downside cushion is represented in the market or is present in it?
I think to some level 5200 seems to have been, at least in the minds of people, become the lower end of the range, and you do see some buying emerge at that level, but that doesn't guarantee that that's going to be the floor. I mean, as I said, one really needs to look for the next set of triggers and cues coming out of the earnings or the monsoon. Positive news obviously is that at least on the political front, things seem to be moving ahead, with the passing of the budget in the Lok Sabha. And clearly, there are some more bills that have been tabled that seem to push the agenda of reforms a little forward. So I think if some of those things start to develop, then I think we might see a cushion on the downside. But clearly, I think the most focal point right now seems to really be the impact of the inflation and interest rates on earnings and consumption.
How much could earnings get dampened because of this combined factors of commodity prices and higher interest rates? What are you factoring in?
we've already seen a 5 to 7% kind of a downward revision in FY12 earnings. So they're closer to 1250 than 1275 on a Sensex EPS projection basis. I think there's a little more downside risk to this given what's happening with oil and commodities. Whether it's 5% or more is really the issue. So not only is the risk on downside on the earnings projections and growth, but I think the other issue also is that what does that do to the earnings multiple per se, and if there is a re-rating yet again, I think then we might see some more trouble on the levels in the market.
How worried would you be about the implications of crude on our own markets with such high oil subsidies and that aggressive fiscal deficit target as well? Do you think perhaps that would be a little more aggressive to meet given the way oil is surging?
I think clearly we didn't budget for this kind of an oil price when the numbers were done in the last quarter. So I think at about $100, $110, people are still kind of saying, okay, this is something we can absorb. But if we start crossing $120, then I think we'll start looking at another bout of worries emerge. So clearly there is a downside risk coming out of that price level. But again, having said that, as I said, things seem to be a little calm at this point at least. So, there are a few forces in the market that are kind of, there's a tug of war going on, and one really needs to see which side of the coin emerges. But I think at this point it does look like that there are more headwinds than tailwinds, and we need to resolve this. And the best case scenario seems to be to kind of spend some time in a zone and let the earnings catch up with the valuations. And once we start looking a lot more comfortable on the valuations front, then maybe at that point we'll see some more buying emerge.
What's your own understanding of the flow situation, Nitin? Over there, opinion seems quite split. On the one hand, that this market is going to see far more by way of outflows, perhaps later in the year, and the other that it may just be a much more shallow outflow situation.
I don't think there is any situation that outflows have actually, caught pace or that the foreign investors are abandoning the market. I think the issue seems to really be this global trade that is still in play, which is the rotation theory of moving, from overweight emerging markets to neutral to underweight, and then overweight undeveloped markets. I think that's why you see continued, a momentum in the U.S. markets. I mean, even Japan was actually doing very well before the earthquake happened. People have started to move a little money back into DMs, over the last few days again. So I think it looks like that. Purely on the valuation front, on the earnings momentum front, there seems to be a little more appetite and interest in the DM trade right now, especially the US markets. And I think that obviously will mean that we will not get the kind of flows we got last year. I mean, net flows are obviously muted to negative, whether you see ETF flows or you see overall mutual fund flows coming into India. On the domestic flows front, I think the good news is that we've had 2 months of positive flows into the equity assets, at least on the mutual fund side. And if that continues, it looks like it will continue at least in March because of tax saving, then at least that cushions the outflow to some extent. But again, I don't think we're going to see a gung-ho environment where everybody's going to scramble to get into India, at least not for the next couple of quarters.
Nitin, that leadership we expected from Reliance was quite fleeting. How are you approaching the stock, and do you believe the second half will be stronger for it?
I think clearly, I did put the stock in a slightly more, focused limelight, at least for a period of time. And I think then the news on their gas front was very disappointing last weekend. So I think at this point it does look like that till such time that those clouds are lifted, there will be pressure on the upside. So clearly, I think one needs to watch out for more clarity on that front and hopefully see, what the numbers show up. But clearly, I think it definitely is something that people are watching out for very closely, and I think at the very least, I don't think one will see declines beyond a certain price.
Nitin, what kind of portfolio stance would you keep right now? For instance, on the index, what are the top 4 or 5 stocks you're still comfortable going out and buying?
I think given the situation right now on the domestic front, we are clearly kind of geared towards a combination of the global theme as well as some defensive. So, we still think that maintaining our position in things like IT services or pharmaceuticals or even banks actually is the right thing to do right now, and probably stay away from some of the, beaten down things like, real estate or even construction. And I think from our point of view, there might be some negative surprises on the commodity front, given what's happening in China. So I think idea really is to have a mix of where we see value as well as where we think there is a global theme to play.
Then you mentioned construction in your list of avoids. Still not convinced about that sector, about how much it's corrected?
I think the issue is much more, what the correlation is between what's happening on the interest rate front and how those companies get impacted. And I think that seems to still be up in the air in terms of whether they've seen the worst behind them or not. Because obviously high debt on balance sheets, high leverage clearly doesn't, play out to your strengths in a situation where interest rate continues to harden. So I think clearly, they might be beaten down, and they might seem cheap. But I think at this point in time, that probably is not the only thing you need to look at when you make an investment decision.
Nitin, how do you think the market will deal with earnings season this time round? In Q3, everyone went in saying, okay, this is discounted, it's in the price. But then the cracks that showed up made the market itself extremely nervous. How do you think Q4 will go by for us?
I think at this point in time, the consensus seems to suggest about a 17-18% growth. Last quarter was much higher, about 25%. So I think unless there is any surprise, to that kind of number, obviously the most bullish estimates are 20% and the most bearish are about 15-16%. But I think unless there is a big shock on that front, I don't think there should be any major reaction on the prices. I think last quarter again people were surprised positively by the way the banking earnings held up or the margins held up. So there's going to be a fair amount of focus on that as well, because that clearly seems to be a lead indicator to a lot of other things that might happen around the interest rate cycle. So I think unless we see something drastically going wrong from that level, which doesn't seem likely given the fact that most monthly numbers on automobiles, for example, have been fairly stable, I don't think there should be any major knee-jerk reaction. But again, one needs to see what the actual follow-through is and what the impact of crude shows up in some of the earnings.